Good morning. This is not what is supposed to happen during times of global unrest. When supply chains across the world seize up, and when global economies are on the verge of recession or even depression, investors across the world move capital to safe haven countries. They buy bonds in safe havens like the United States or in Europe, or they move money to American banks. What's happening this time is the opposite. U.S. government bonds are in liquidation. March 2026 was the worst month for Treasury investors since 2022. The American debt market already has headwinds with $10 trillion that needs to be rolled over this year and at far higher borrowing costs than when originally issued. Now there is a war on. The Department of War is asking for another $200 billion and is burning through billions of dollars of weapons stockpiles every week, and so investors are looking somewhere else. Typically, that somewhere else might be the United Kingdom. They are not at war with Iran, and one might think London would be a safe haven for those who don't want to send their money to New York. But that isn't happening either. 10-year government debt in the UK is higher today than at any time since the Great Financial Crisis. These are 10-year government bond yields from across the world. The so-called safe haven investments of the US and UK government debt, those yields are rising. China, in comparison, is at 1.82% and falling. Put another way, the Chinese government can borrow money for 10 years, and their interest payments on that debt is 1/3 what it would cost the American government to borrow that same money. In that context, the capital outflows from the Persian Gulf are accelerating, yet they are not going to higher yielding investments on offer by the United States or Europe. It's going to Hong Kong. Wall Street and European asset management firms are expanding in Hong Kong to take on new clients who are selling off assets across the Middle East and bringing it here to China. For investors in Dubai in particular, Hong Kong is a way to diversify their risk. China and other regional economies have stronger economic growth, and even the sovereign funds, those are government investment pools, were making the shift to Hong Kong. Banks in the Persian Gulf region are badly exposed to capital flight, with over $300 billion that may move out, depending on how long the war goes on. The S&P's analysis of the problem assumes that the intense phase of the war lasts 2 to 4 weeks. We're already past 4 weeks, and Dubai itself is being targeted by Iranian rockets and drones. The objective of shifting assets away from banks in Dubai and the other Gulf states is to diversify that risk during wartime. Capital flight is a wager by investors about perceived safety, but the so-called Iron Dome cannot protect Tel Aviv from ballistic missile strikes from Iran. American Air Force bases and even embassies are being hit. Iran has closed the Strait of Hormuz, and only ships from friendly countries, like China, are allowed to pass through. So maybe these investors are thinking about all of that too. This is Chongqing. Be good.
And a good brother to my brothers and sisters. Fill me with truth and integrity. Make me a man of trust and honor. Go with me as I lead my family and my loved ones to salvation, as I show